Big thank you, because I know you actually are on holiday and you've come and taken time to be with us here in London in person today. So thank you so much for coming. And before I get started, we actually have something in common, in that we are both creatives. You were an actor. I was a TV presenter when I was younger, and now we're both also investors.
So, the natural transition.
Natural transition. So please, creating Blue Haven, but also particularly, what flipped your switch to go full impact?
Sure. So hi everyone. Nice to be here. I don't know if I'll go as far back as the acting career go. Although actually, I keep joking that I want to write a book about how acting and rehearsals and auditioning are actually really terrific prep for investing. And if I ever, is that not working? Sorry. Oh, there we go. All right. So yeah, that kind of having a background in theater and film is actually really good prep for investing. If I hear one more fund manager or entrepreneur complain about how many pitches they had to do, try walking into an audition room and being told, you don't even open your mouth, and they go, no, and send you on your way. You are not pretty enough. Go out of the room. Toughens you up. So anyway, but really where my journey with impact investing began was I was born into a family that had a lot of that wealth when I was 21. And so that was about 18 years ago at this point. And what I decided to do with that wealth kind of is what has become Blue Haven and what has become this journey. And that 18 years to kind of get to this point, but really kind of how it started was I had these assets, and they were in a kind of traditional financial portfolio. The other thing that's sort of unique about my story is that I had sole control over these assets. That is very weird in family office world, but has also, I think, resulted in an accelerated kind of journey into impact investing, but I'll get there in a minute. So anyway, I was 21, had these assets. I was in college at the time. I decided that I didn't want to with a creative acting career. And I had other interests. I was studying African history. I thought maybe I wanted to go into international development. And this was also around, so it was 2005, around 2006, 2007. If you recall, that was when Muhammad Yunus won the Nobel Peace Prize. Microfinance was the really hot, sexy thing. Market-based solutions was the thing that the development community was starting to talk about. Business approaches to philanthropy, that was all the stuff that was going on. And so kind of first I set up a foundation that my mother runs, that focused on financing for low-fee private schools in Ghana. And I worked on that for a while. I worked at another microfinance organization and also thought, okay, microfinance, it's interesting, the silver bullet, but there's a lot that markets can do just to deliver basic services and sort of scale them in a way that opens up economies in very productive ways. So that's kind of interesting and exciting, and I liked that. But I was doing all of this, and then over in Chicago sat my financial advisors at Merrill Lynch who were, investing my portfolio, and really it had nothing to do with what I was spending every day doing on this microfinance in Tanzania. And then at some point, working on this school lending program, we got to a point where we needed to start getting outside capital into the debt fund to start to scale the program up. And working with the microfinance organization that we were saying, okay, well, where do you get your debt financing? And they were talking about their debt markets and OICO credits and all these different microfinance investment vehicles that they go to get capital from. And I started to kind of sit back and I was like, wait a minute, not particularly in this one program that I'm working on, but just generally speaking, I could invest in finance investment vehicles. Like, these entities have been around for 30 years at this point. I could invest in some of these from this money that's sitting over there with these financial advisors. Why don't I do that? And so I called them up and I said, hey, you know, I'm working all day on this microfinance. Could I invest in this? And they were like, no, you do not understand currency risk. You don't understand emerging markets. You don't understand frontier markets. We're very good at our investing work. You go off and you do your sweet stuff. And it's so great that you're trying to save the world, but leave the... And again, this is like, you know, 2008, 2009, the impact investing space is nowhere near as robust as it is today. The term itself was just starting to get used. Conferences were just springing up. You know, JP paper, like there were like a couple of these little things that were starting to happen, but I certainly didn't have the language to ask for aligning my portfolio with things that I cared about. And certainly my investment advisors did not have the skill set nor the infrastructure within their own firm to deliver it. And so, but it was that kind of like total disconnect about, hang on, I'm spending all of my time and my energy and focus on this thing that actually has a connection to market. And I have a ton of money I'm sitting on. Why can't these things come together? And maybe it's not that microfinance deal, okay, fine. But there's got to be a way to be more synergistic. Why am I spending 100% of my time on no touches at all? And so that was really what kind of got me upset. And I felt like I'm like reverse leveraging what the capital that I could actually put to work towards doing really cool stuff. And so, and then the part that I think gave me a little bit more confidence to say, you know, okay, maybe I should go ahead and do this. Because again, I didn't go to business school. I am, as we pointed out, I'm an actor by training. I'm very easily out-jargoned by fancy private wealth managers. But then the financial crisis happened. And I was like, wait a minute, you guys don't know what you're doing either. Wait, maybe, you know what? Like maybe I should just go, maybe I should pursue this. And so I started going to the conferences and started reading the white papers and started meeting with other investors, started putting those other investors on my investment committee. And then through that, we then moved firms, we moved advisory firms. Now we've brought a lot of it in-house and built up our own investing capacity to do exactly the kind of investing that we want to do. And so now what we've got today is, so Blue Haven, and one of the things that sort of I think made us different from the get-go was I said, after I sort of had these epiphany moments, I was like, I want to do this with all of my money. I don't want a carve-out that is the impact money, and then here's this other money over here that we're not going to talk about. You know, like, oh, okay, we'll talk about our, because I see this sometimes where we talk about the amazing things your philanthropy is doing, the really cool things that your venture capital impact investing is doing, and then there's this other like secret nebulous stuff that nobody wants to talk about. And I was like, look, let's do it. If we're gonna do it, let's do it like the whole way. Like I can't be a little bit pregnant. Like I need to like, the whole thing has gotta make sense. But that's gonna be tough to do. It's gonna take time. We're gonna stumble along the way. But what would it look like if we did that? And how would we approach it if we truly said we want to know what everything's doing and we want to raise the standard of what every investment in the portfolio is doing and be accountable to its impact profile as well as its financial profile? And so that's kind of how we built.
And that includes public equities, direct investments, private equity. You know, much of what I've heard about on the impact investing side, either it's a lot of philanthropic capital or it's a lot of venture capital. But you went full pregnant, I can say that, Connor. And did it across all, which is, you know, incredibly unique and incredibly bold as well. And so the question of just, impact investing versus traditional investing, you know, the notion of that, like how in your mind does this, they sit adjacently to each other, and impact is not the same for all investors. So, you know, where is it when they can conflict? And I'll say this because I heard you speak about an experience of someone, an individual you spoke to in Taiwan. I'd love for you to share that story with the group as well.
So the thing is that the way that we view impact is, you know, and I think that there are some really great frameworks out there. We use the impact management project framework around sort of A, B, C kind of level steps of how much you are contributing to solutions versus just avoiding harm. I think that's a very useful framework, a bit towards asset classes. But generally speaking, what we did was we thought, listen, we're not going to reinvent like modern portfolio theory. We've got a lot of assets, we've got a time horizon, we've got cash flows, we've got, you know, goals about what we want to pass on to our children, things like that. Let's start with a relatively straightforward asset allocation. I'm not trying to completely dismantle financial systems here. So what we did was, given all those inputs, given our philanthropic goals as well, because we still do give a lot of money away, you know, we sort of generated an asset allocation that makes sense for for me and my husband and our goals. And then what we did was we said, all right, within each asset class and sub-asset class, we want to find managers and strategies, and then companies on the direct investing side, where we're actually in sort of that bullseye of the impact is embedded in the business model, it's embedded in the financial opportunity. And that is not the case all the time. I'm very straightforward about that. I think there are absolutely situations where there are trade-offs. We're looking for the ones where there aren't, to fill this particular portfolio. And so then what we did was we just kind of went through each asset class and looked for, you know, whether it's in affordable housing, whether it's in private real estate, whether it's in private debt, other kinds of alternatives, infrastructure, like what are the sort of coolest, most impactful funds out there, and then started to populate the portfolio there. And what we ended up with, so we took this kind of like top-down sort of asset allocation-based approach. And what we end up with is diversification, of course, along financial metrics, but also diversification along impact. So what we did not do was sort of start out by saying, this whole portfolio is going to take X amount of carbon out of the atmosphere, or it's going to, you know, educate X number of adolescent girls, or it's going. We didn't do that. We do that at the fund level. And that is to give us the absolute widest and broadest range of investment opportunities that we can have. But one of the sort of the flip sides of that is that one could say we get a little squishy with what we mean by impact. Like, we don't have one total North Star of the thing we're trying to fix in the world. And that's probably because I'm more pluralistic than that, and I think there's like a lot of stuff that's got to get done. But we don't have like one guiding impact principle. We do have some things we will not touch at all. And the kind of the mantra that we use at the family office is, we will not invest in anything that, when used properly, kills people. So the when used properly that means like alcohol in, tobacco out. And also munitions, guns, defense has also, we have pushed that out of the portfolio. But like mining, extraction, the better ass sector, on a very, very particular and limited and choosy basis. But with the defense one, though, I thought that was like, obviously, right? Who's gonna like buy guns? Who could like stand up for that? And from an impact perspective, right? And dry. And then I was at a roundtable with another group of investors, and I was sharing this, and there was a guy from Taiwan that was there, and he was like, no. He was like, my impact portfolio is defense companies. Because in my country, like, these are the things we're gonna need if we go to war. This is serious for me, from my perspective. I have an imminent threat. You can sit there in the US and you have your own problems, and I totally get that. But for me, that absolutely does not fly. That means nothing to me. And so I was like, okay, you know, like, I hate to sort of say, all right, impact's in the eye of the beholder, but what I have found is that a holier than thou approach to impact is just dead on arrival. And we really try, I can come at it and the things that I think are important, but there's a lot of, I think curiosity is the most important aspect of doing this kind of work. And always being able to sort of like pull out the eraser and think about something again.
But you can also then invest about understanding each other's goals and objectives, essentially, beyond risk return. So tell us a bit more about Blue Haven. I mean, incredible, one of the largest investment funds dedicated to impact investing. I mean, you know, that classic 101, can you make profit and return, profit and purpose, and, you know, how can you do it beyond different asset classes? What differentiates Blue Haven beyond that incredible fact?
Well, so I think the part that we've really tried to kind of lean into is that, you know, yes, most of our day-to-day we're an investment fund, right? A single family office. And so we have political interests, we have philanthropic interests, we have a range of different things and different different types of capital that we can lean into and invest to sort of move our goals forward. And so always tried to do from the get-go is really understand the limits of our investment portfolio. So I don't think venture capital is going to get us out of the climate crisis. I don't think investment portfolios generally are going to. I think we need very serious government incentives, we need civic engagement, we need lots of things that are not market-based in order to solve a lot of the problems that we have. And so one of the things that we spend a lot of time doing when a deal comes across our desk is this the right tool? Is this the right thing? Is this thing the best way to hit that kind of impact? And oftentimes the answer is no. You know, in 2014, 2015, one of the first investments that we made in our direct investing portfolio was a waste-to-energy company that worked in Kenya, Rwanda, and Ghana, and sort of turning fecal sludge into energy that could be burned instead of coal. Okay, great. So we, alongside a bunch of other investors, used equity to invest in that company, which is actually pretty silly when there's no municipal bond market to actually be the off-takers, to actually take that kind of innovation to scale and into the cities where it's needed to be. You need a muni bond market in those kinds of cities, which does not exist. And so that was like a big lesson of like, good innovation, wrong tool, wrong time horizon. And so we truly try to be, and because we're portfolio investors, first of all, everything to look like a VC deal. And on top of that, we also have philanthropic capital to say, well, wait a minute, I think the UN Capital Development Fund is launching something to look at how do you launch muni bond markets in other cities? And so we started a conversation with them. So like, are there other things that we can do, other parts of our capital stack where we can plug into a problem that we learned about, but is not fit for that part of the portfolio?
Yeah. And sometimes, I think you've also described in our earlier conversation where tools can work together. So, for example, your philanthropic capital and how it supports, thinking about the climate crisis. Can you speak to that a bit more, and how youth voter engagement leads to enabling climate change?
Right. So this is one part of our portfolio, or of our activities, really, that my husband heads up, is our democracy building and civic engagement work, which when I met him in 2010, in like the heyday of the Obama years, I was like, what do you do? What do you mean you do democracy building? Like, that's not it. We're doing a democracy. Like, it's all solved. We're all good. It was like, actually, no. And, young people turned out for Obama, but they're still pretty disengaged, generally speaking, and this is actually this is an existential threat to our country. And he's saying this in 2010, and everyone was like, no, you're crazy. Cut to today. And so he started a project in 2012 that started to measure youth voter turnout on college campuses across the US, and which actually hadn't been measured. And regardless of how they vote, when do they vote, and how do you help colleges, actually, which are nodes of young people in our country, take responsibility for upping voter turnout on their college campuses over time. And they created competitions and all kinds of stuff, and it's actually working. Anyway, cut to this a couple years ago, I was asked to give a presentation on Blue Haven's climate portfolio. So every investment in our portfolio across asset classes that touched climate. And so I'm assembling this, I've got all the logos on, here's all the investments. It's like 125 million at that point that was active and out. And then somebody asked me which investment on this page has had the biggest ROI from a climate standpoint, from like a carbon standpoint. And I was looking at it and I was like, oh shit, it's not on here. It's actually Ian's youth voter engagement work, because young people turning out to vote in droves unexpectedly in 2022 in particular sent a very clear mandate to our Congress in the US to pass the Inflation Reduction Act. And they said that. They said, this is to lock in the youth vote in 2024. This is why we're doing this. And so we hear you, and this is our response, is the Inflation Reduction Act. And so the thing is, like, is anything perfectly attributable? Of course not. However, that work that he'd put in for a decade on building coalitions around getting young people to vote, I think has had more ROI, even if I can't perfectly attribute it, than any particular one climate investment that we have in our investment portfolio. And so that's not a ding on any of our companies or any of our funds, which are doing incredible work, to take a step back and look at how this all plays together. It's a whole ecosystem, and we need all of these pieces to go together. And so that, I think, is one thing we've always been trying to do at Blue Haven is how do we use all of it? It's not a question of, private sector is better than the public sector, or it's not that. We need all of it. And so I think that's probably one area that makes us unique.
So I have a serious question.
Okay.
Do you recommend the husband and wife duo?
Well, you've caught me like in the middle of a really nice family vacation. So yeah, everything's great. He's watching the kids right now while I'm here, so it's perfect. Actually, I do really like it. I think one of the things where once we realized where we really agree on like the big stuff. We agree on like what is right and true, and like we're both also fairly pragmatic. He's more of an idealist than I am, which is why he can stomach doing the political stuff. And I'm like, I'll just do the investment stuff because it makes sense to me. But we agree on kind of the big stuff, and then we have complementary, once we just figured out what our complementary skill sets were, which is like part traditional couples therapy, and then part like work style.
Sounds very constructive.
Right,
Couples
we're
therapy.
both high yellow. And so once we figured that out, things fell into place a little bit better, but we do, I think, also run the risk though of like, you know, waking up in the morning, opening email, and then just starting to work. And so that's the one part that's not great. But then the kids jump in and that all goes out the window.
So, I mean, where do we start? You know, where, no matter what our wealth, you know, as you said, you took a set of assets that you had and you framed it into, you know, an intention toolkit now that you're, you know, working to serve both, you know, your preservation of wealth, your children's wealth, but also for a future that you want to see. And no matter what our wealth, I'm assuming, you know, these folks in the room, folks listening, you know, have that journey and inspiration too. So what advice would you share for us on that?
I mean, I was talking about this earlier a little bit. One of the things that is been a driver for me around this, that dovetails well into the impact investing space, is that is a sense of accountability, taking responsibility for things that you do or things that you have. And so for me, just very personally, some of this comes from a little bit of like inheritor's guilt of like, I did nothing, sat here and got control over all these assets, and I need some accountability to them. And so one way to do it is to say, I need to know what everything is doing, and it is on me to make sure that it's doing good things, and if it's doing something bad, that's my fault. And so, and I need to clean that up, and I need to make it better. And so part of that, and I think that that personal sort of psychology actually works well in the impact investing space, which is probably why I kind of migrated over to that. But regardless, I just have that guilt on steroids, but I think that everyone's work and every place and movement in this world matters. And so it's just a question of taking responsibility for what that movement is and being accountable to it. And not thinking that the things that you do don't matter. They matter, they really do. Regardless of who you are, where you are, what position you hold. And so I think that's the thread that runs through all of us. And so this is the way I've tried to kind of express that accountability in a way. And part of the reason also is probably another thing that makes Blue Haven a little unique is that we're probably as public as the family office can be, which is to say a little bit. But that's part of why we've wanted to be so public, is when we, you know, we should, if we get it wrong, tell us we're getting it wrong. Because there's not a lot of accountability in the single family office space.
I mean, you also do a lot of work beyond your own single family office in advancing the field of impact investing, working with emerging managers, you know, new companies and other family offices and collaborating with them. So, you know, why are you taking that? And I say that because, you know, obviously being part of the Conduit, we see a lot of change makers here, whether they're entrepreneurs, you know, emerging fund managers, trying to solve problems, thinking about civic engagement in some shape or form. You know, so we see a lot of this real time and connect with each other real time as well. So why did you decide impact, which is the number of large single family offices that are collaborating on impact endeavors, and then impact assets as well? So why have you taken, you know, the cause of supporting emerging managers and emerging companies?
Well, I think that I know learn best from talking to other folks that are doing this smarter, struggling with the same issues, or have a totally different idea of like, nope, like, don't be impact agnostic. You've got to focus on one thing. Here's why. Like, those debates are where I learn the best. And so where are the spaces for those debates, right? So here at the Conduit or networks that we're a part of, I think are invaluable for learning and for sharing. And I also think, though, is that it should be a whole lot easier than it was 12 years ago to build a full portfolio. You should be able to kind of like flip a switch, pretty much, if you've got a good advisor, and at least be able to fill in part of your portfolio fairly quickly. And then what's great about that is then you can get creative and say like, this is bullshit, and I want a product that looks like this, or I want that. Like, that's where you get, the really cool frontier stuff happening, is when the initial plumbing is already there. And so that's why I think it's been important for us to help to kind of build the field very selfishly, so that it is not as hard as it was a while ago.
Well, I think that benefits yourself, but also a wider group and a wider ecosystem by doing that as well, to have those perspectives.
I think it also, what's kind of fun is being at this stage where I've been doing it for long enough to be able to determine when something is genuinely fixed, or when it's like, no, you don't understand that. Like, sometimes I get, when I talk to traditional investors who are like, we're interested in this impact investing stuff, it's just we cannot find any funds. There are no funds. And I'm like, no, that's a you problem. That's, you don't know where to look. That would be like me walking into a hedge fund conference and going, I can't find any hedge funds. Like, that's me not doing a Google search. Like, it exists. That's a me problem. As opposed to things like, ESG metrics, right? That's a genuine mess. That's a genuine mess that needs attention and needs to get fixed. And thank God there are lots of people working on that. But like, being able to determine what are like, that's a you thing, and no, that's a field thing. Yeah.
So I want to end on a story from you, not from me. But I, in being a private equity investor myself, one of the things that the field applies is this idea of value creation. So post an investment, where are you directly creating value for that particular investment to make it return whatever it's returning, basically. Well, Africa Initiative, which again is a not-for-profit endeavor, which is actually focused on enabling some of your investments in Africa. And so I'd love for you to talk about some of that work that you did. And again, I think it's another example of a tool, but just another great example in an emerging market.
Well, so though, just to be clear, our direct investing, there's both for-profit and nonprofit. So about 9 years ago, and this sort of built off of my microfinance, when we decided that we wanted to take a portion of our private equity portfolio, bring it in-house, and build a direct investing portfolio, an evergreen sort of early stage venture portfolio in-house, we decided we wanted to focus on African fintech. And that came out of my experience with microfinance that turned into digital financial services, and seeing M-Pesa take off, and seeing mobile money. And you've still got, a young, digitally savvy, wildly underbanked population, and with deep comfort using mobile money. I was like, this fintech playground, and it has been. It's been really interesting to see those models emerge. So on the for-profit side, our that evergreen portfolio, which is looking for venture returns, we started investing in a number of fintechs and logistics businesses in sub-Saharan Africa. We were probably a little early to the market, but things started heating up more recently, and so we've had a couple of exits in the last couple of years, which has been nice. But then on the catalytic capital, or not risk-adjusted return side, one of the things that we've also started to do is warehouse deals for emerging fund managers. So one of the things that was frustrating back in the early days is that it was like us, one or two funds, and then a bunch of development finance institutions, a couple of foundations. Like, it was a real of investors that we're starting in that sort of African venture space, and it was not ideal. There should be many, many more local investors. There should be a lot more seed capital. These ecosystems should be bigger. It shouldn't just be money flooding in from outside and fly-by venture partners like us. There should be a lot more kind of a robust local ecosystem. And so starting to, but then how do those first-time fund managers raise capital? You know, where's the track record? Where's the, you get all the questions that first-time fund managers get. And so that's something we've also seen investing alongside, but we also want to make sure that, you know, in 3 years from now, we should not be doing any direct investing. That should all be through funds we're invested in that are now on Fund 2, you know? And so how do we sort of build that talent pipeline? Because it's there, it's just they've all been working for other firms. They don't have their own official track record, and so those are things that we've been trying to push through, but also understanding that they are riskier. You know, getting to your first close may not happen, and so how do we kind of so we've done a lot of our catalytic capital bucket, which is an investment bucket, but we don't need to make market rate returns on that. That's for high risk, super impactful stuff.
Right. Thank you. So yeah, turning it over to you folks. So yeah, do we have a mic? Thank you.
Thank you. Thank you very much, Liesel. That was very inspiring. I'm curious to hear from you from two perspectives. What's next for Blue Haven, for you and your family, as much as for Blue Haven itself? It takes a child, you've taken charge, it takes an even bigger village to fix the problems that we have. So I was interested to understand your thoughts. What's the next step for you on your journey?
That's a very good question. Thank you. One of the things that I'm finding, and when we've been doing this a bit more lately, is really kind of staffing up more. You know, I don't want Blue Haven to just be like the Liesel and Ian show. It's a whole really amazing and cool and doing this work and really leading it at this point. And so this also coincides with like wanting to take a little bit more time with my kids and stuff like that. So for me personally, I have found I'm naturally wanting to like, no, I'm not going to take that meeting. Daniel, you take it. Like, kind of trying to build the team up a bit more. And then what that sort of means then for the firm is we're doing a lot more. So we've also kind of transitioned from having most of the assets advised by outside advisors to kind of switching that shift and doing more of the allocating and the sourcing of funds. Deals we've always done ourselves, but more of the sort of marching along the other asset classes as well and doing more of that in-house. So yeah, just, and getting in earlier, doing more boutique structuring. We also are trying to really lean into the fact that we are a single family office. Like we're not a foundation. We have investment professionals. Like we can look at a weird project that looks very strange and other investors may not want to look at, but we're curious about it for other reasons as well. So we're trying to kind of build up that muscle of how do we really lean into being nimble and flexible as a family office. And if it looks straightforward, that's awesome. Investors can do that. Yeah.
Thank you.
Hi there. Thank you so much for your openness in the space and for taking time out of your holiday. A question about the various asset classes that you invest in. Which do you find the most challenging to make decisions on? And what reasons do you find that? And granted, the impact space is 2008, but are there certain things that you are still wish the market was presenting you with options?
Yes. Buyout, private equity buyout space is pretty sparse. I think just generally speaking, sort of hedge funds or that kind of style, although it's questionable as to whether that style could ever be an impact strategy. I mean, you're just going to short the bad company. I don't know. There's questions around that, but we've managed to sort of be able to fill in that category with them. And then the one that I always I have questions around, but it's in our portfolio because again, we're a broad portfolio and we need liquidity is, passive public equity, right? You're sort of only as good as the analysts on that particular strategy. And I feel like I don't really have sight into exactly what's in there and why. And we do audits of the passive public equity and always find stuff where we're just super confused as to why that's in, why that's out. And we have some custom strategies. I don't know. That's when our active managers are awesome. They've got a thesis. They've got a real they have very particular reasons why they're picking those stocks or engaging in those particular activist strategies. So I'm fine with the active public equity, but the passive ones, I don't know. To be.
Hey.
Hi.
I found it really interesting, the democracy work that your husband was focusing on. Obviously, it's really important, but my question is, how do you guys get a financial return for doing that?
So, I mean, the answer is we don't. Just to be very clear, nobody should make money when lots of people vote. That would be very bad. But from a 20,000 foot view standpoint, to play the counterfactual, I don't want to live in a fascist authoritarian society. I definitely don't think I'll be able to make money then. Particularly me, I'll get thrown out to somewhere else being Jewish. So I will definitely not make money. The way capitalist systems work are when we have free societies. The debate of capitalism is good or bad. You don't need to have wildly unfettered capitalism in free societies, but there is a correlation between democratic societies and general broad-based economic development. And so that, I think we need fair rules, we need to have rule of law, we need to have court systems that enforce antitrust laws, we need to have, all of those things need to function in order for investors to then play and do what they do and find incentives and be creative. If it's the Wild West out there, if it's chaos, no one's going to make any money. And so that's the cynical view. I also think, in things like freedom of speech and generally freedom, but yeah.
I have a related topic. I totally agree with everything you've said, and I've been struggling my own work in that space. For the last 7 years, I've done crowdfunding, so I've just asked the public to help me with it, and we've raised almost $1 million from doing that, but we need to scale up and do a much bigger thing, right? So what we're doing is we're trying to prove, using the criminal law, that when elected representatives repeatedly lie to the public about matters of public importance, and you have lots of evidence to prove it's happening, we're trying to prove that in very special occasions is a criminal offense. And we're doing that by, we tried in 2019 to prosecute a high-profile politician here, try again next year. And given what we're trying to achieve, and don't worry about freedom of speech, because we've already legally found the solution to that issue. It doesn't infringe upon freedom of speech. Given that, how would you advise me to raise the bigger kind of money that we need? Because what we're trying to achieve is huge, it's massive in the world. And crowdfunding is not going to be enough. So how do I do that? How do I raise that money?
So I think, this is, and I wish Ian was here and we can follow up with that as well, because he would have very specific, but one of the things that he started to do, and it was an election where this actually worked, was one of the things he was trying to do, and he wrote an article in 2011 saying, and it was called 1% for Democracy, and it was saying that every philanthropist should devote 1% of their philanthropy making sure our democracy stays democratic. And for democracy building efforts, whatever that may be. This sounds like one of them, like holding politicians accountable, getting money out of politics, like, you know, making sure everybody has access to vote, like the basic things like that. It doesn't even need to be particularly partisan. And just to say, almost like a tithing, like just whatever your pet cause is, if you're about animal rights, if you're about, you know, the environment, if you're about, you know, a woman's right to choose, whatever your pet cause is, it's going to go away, live in a democratic society. So it's in everybody's interest. So I would say try to connect government accountability to what everybody's pet cause is. Whenever you go to funders, like, why is this actually important to conserving national parks, right? And like, what's the tie-in? Because that's holding our politicians accountable for what they say and when they lie undergirds any other issue. And so I think making it universal like that might have some appeal, but again, it doesn't. Sometimes people have trouble seeing the foundation when they're looking at their flag, you know? Yeah.
A quick question for you. So, congratulations on I think marrying a really progressive approach to impact. I think it's great. My question is about returns. How are you doing return-wise, and how do you kind of measure returns and think about returns? Is it? I'm assuming there's a little bit of financial return, and there's also kind of an impact measure. I was interested to hear.
So on the financial side, along with our, you know, kind of our asset allocation, right, has a risk return target. And then we benchmark against that. And we look at absolute return as well as the custom benchmark. And over the 12 years we've been doing this strategy, we're kind of like right on the benchmark. And our benchmarks are not ESG, they're traditional. Like we actually just want to see what we would have done if we hadn't have done any of this. So for better or for worse, they're kind of like right on. And so we tend to find that, I mean, we probably were down a little bit more because of our lack of exposure to oil in the last couple years, but that also means we were up for the other 9 years that oil was down. And so people forget about that one when they oil. I'm like, guys, you can't cherry pick. So I'm actually quite happy with where we are, generally speaking, in our portfolio. And then as it should be, our kind of, as we move into the private and more venture style part of the portfolio, it's kind of doing what it should, right? Where we've got like some winners and then like 3 write-offs and then like, you know, it's what it should be, you know, it's doing what it should be doing, basically. So on the financial side, that's sort of how we measure that. Nothing new there. We really work with our fund managers to find metrics that pertain to whatever the thing is that they are doing. So with affordable housing, it's units built, it's underserved communities, it's, you know, it can be retrofitting people with access to community services, which are then very, very different from, you know, a fintech company in sub-Saharan Africa, where it's users and it's repayment rates and it's credit worthiness and access to broader financial services. And so we have tried and tried to roll everything up into one like beautiful framework. And we have found not only does that not work, it's not useful. It doesn't tell us anything. And so we find that at the fund level, did this investment do what it said it was going to do from an impact standpoint and from a financial standpoint? And then that leads us to better decision making. So it's sort of the impact reporting is part quantitative, part qualitative. But I don't know. Sometimes people say, oh, it's too hard to measure impact. But I find that our financial reporting is also part quantitative and part qualitative, right? If this particular, if markets were up in, Q2, but this manager was benchmark, there's a story behind it, right? It was either stock picking or it was either their style. They're a value manager and a growth like there's a story behind it, and you want to find out what that story is before you sack them for not hitting a number, And so I don't feel like the impact reporting is any squishier than the financial reporting in some regards. Yeah.
So I know we have a couple of questions at the front, so I'm going to give my mic over here, and I see you at the back, so you're next.
Thank you. Thank you, Lisa, for being so open on your investment journey, and just maybe asking for a friend. But do you have any advice for young investment professionals on bringing impact into the spotlight regarding the investment lens at the fund, venture capital fund, or family office they're working at?
Well, I think highlighting that it feels to me like a trend, not a fad. And I think the numbers all go in that way. But I also think that one of the biggest drivers of this is actually existing talent who wants this at firms. That's what's driving it. If you don't have an impact practice at the firm, or it's not something your firm is looking at, you're not going to get top talent. Top talent from business schools. The #1 club at HBS is the Social Impact Club. These are places and conversations and that young people in this space want to be having more and more. Law firms are using their pro bono impact work to recruit law students. So this is the thing. I think making that vocal and saying, you might lose me if you don't do this, I think is also very powerful, because ultimately they'll listen to that. If they can't hire, and if the firm over there is getting the best people because they have this, that's something to listen to. And I think, I think it's pointing to other examples, other large firms with credibility. One of the things I did early on, and I will forever be grateful to Ron Cordes, who runs a foundation called Cordes Foundation. But before that, he ran a huge asset management platform called AssetMark. And then sold it, and with all of his money made this thing called Cordes Foundation, and they did a lot of impact investing very early on. And Ron, so when I was just trying to convince my Merrill Lynch financial advisors to sort of do this or get into it, I was telling Ron, so I met him at a conference and we had lunch, and he was like, you should go ahead and do this. And I was like, they're not listening to me. And he's like, and I was like, can you come? Can you come? You are a man, you have gray hair, asset management business, you come. And you say it, because they'll listen to you. And so I think also finding proxies, as much as it sucks, but finding proxies with credibility who can make the case for you. And I am definitely not that person who can speak that language and basically vouch that this isn't stupid, it's actually a real thing. But that was fundamental. And I just wrote, so Ron and I served on a board for a number of years, and he just rolled off that board, and I wrote him a 6-page email basically the other day where I was like, Ron, do you remember that time you came to my quarterly meeting and you sat there and you convinced them, and it was amazing? And so it really, that made a big difference. Yeah.
Talking about Ron, his daughter was just here on a vacation. So, yeah, this is a good place to be this summer, particularly with the United States burning up. My question is, so Blue Haven is an investment firm with a variety of different asset classes and investments, but you also mentioned philanthropy. So I was wondering what percentage of portfolio philanthropy, and do you have certain fields or classes of philanthropy, or what is your benchmark for philanthropy?
So we do, we do about sort of 4 to 5% of AUM a year granted out or invested in below market investments. And so we almost, even though we're a single family office, like it's a little bit like a US kind of private foundation kind of model. So we give a fair amount of money away every year. And so the focus of that, so Ian's work, as I mentioned, so we like a good couple, we split it 50-50. And his work is around democracy building and civic engagement in the US particularly. And then my work is around impact investing, ecosystem building. So finding new fund managers and patient capital to get them off the ground. Then things like funding some of the work around the ESG standards here in the EU or in the EU, like the IFRS value reporting initiative, SASB, all of that kind of work, some of that plumbing around getting the ESG mess a little bit cleaner. We do things like that. We fund a bunch of sort of accelerators and incubators for fund managers as well, companies, and then support a number of different networks. So a lot of it is around trying to get more capital flowing to the impact space, particularly is where our efforts go. And then some things that are almost like a cross between the two. So one of the organizations we funded for a number of years, and the gentleman who was talking about the holding politicians accountable reminded me of one of the organizations we love is Client Earth, that's based here in London, that uses civil law to say, okay, great, we've got some really cool climate policies, but do the communities, when corporations break the law, who's there to, do local communities actually know that? Do they know they're breaking the law? Can they hold those those accountable and say, no, you're not allowed to actually put that plant there? And so things like that. So that's where a lot of our philanthropy goes, is around, civic engagement, democracy building, and impact investing, ecosystem building, which is a mouthful, God.
Hello, me over here.
Oh, hi.
Hi. I wanted to ask about, and it's a follow-up from the question on returns, what you do to ensure or measure additionality, to have an idea of what the impact would be if you hadn't invested, and beyond what would have happened otherwise.
So that's a great question. So in our like broader investment portfolio, where we are looking for market rate returns, we track additionality and investor contribution, not a prioritized metric in our due diligence process. I'm not so interested in that part of the portfolio of like being the first money in. I'm interested in what is the thing doing? Is it awesome? Like, can we justify this to our investment committee to meet our return targets for that part of the portfolio? If we are additional, that's gravy. That's awesome. Like, that's very cool, but it's not a weighted factor going into our selection process. Now, in the philanthropy and in our catalytic capital bucket, like very specifically when we warehouse deals for fund managers or things like that, then that is exactly where we want to be: catalytic, additional, first money in, take the risk. So we designate it, though, in that way, because, again, I can't, this is just us. It is not important to me with a lot of the assets if it was like, but for me, you know, like I want it to be doing something really cool. But if I'm taking a super outsized risk, a little bit more important to me. So that's how we do it. But a lot of other people place more on additionality. I don't know. I just like, it feels weird to sit and be like, tell me all the things that happened because of me. But we try and do stuff that we can't, you know, like bring other capital in alongside us, like just do the stuff that nice people do. I don't know. But yeah, that's how we designate.
I have a question for you personally. I'm witnessing you go from someone who is moving people and now who has authored a story that is moving people, including me. And I'm really curious for you personally, when you look at suppose 100-year horizon, what is the legacy that you want to leave behind for Blue Haven and for your children's children? And with that, what chapter are you in now in that story that you're writing?
Wow. I don't know. I mean, honestly, I don't have like a perfect grand sort of vision around it. I think what it has to do with, I guess, kind of coming back to that accountability. And I'd say the things that are really important to me, and my husband talked about this with the kids, is accountability and curiosity. And asking questions, and then actually doing something based on that. So a bias towards action. And again, I hate to use a gun metaphor here, but saying as we're not invested in defense. But my kind of philosophy is ready, fire. You know, kind of like do something and then sort of figure it out. But like sitting forever in a room with a whiteboard, blue skying, and getting like a beautiful McKinsey report, like I can't, it doesn't work. I have to learn by doing. So I guess in terms of legacy, what I'd like to leave for my kids, be curious. Don't be afraid to actually do things, because Jesus Christ, if you, the luckiest person on earth, can't fail and fail publicly, like nobody else can, like get over yourself, you'll be fine. So be curious and then clean up your mess. Clean up your mess as you go and try not to make messes, would be the kind of the basic guiding principle, which is pretty not particularly eloquent, but I think hopefully fairly pragmatic. But I don't want to. Another thing is, this may not be their passion, and this may not be the thing that they want to do. But those things, though, those are non-negotiable. You have to be curious about what you do. You have to do it, take risks, and then you have to clean up the messes that you make and be accountable. But I don't care if that's becoming a chef or being a ballet dancer, but those things have to stay. But I would be okay if Blue Haven doesn't exist in this image going forward. You know, I'm only here for a period of time. So I don't know, I don't have a whole lot of attachment. I'm not trying to build up a firm or we've talked about this before at the office of well, would we ever, because we get asked, would people want to co-invest with us? Should we become a multifamily office? And we're like, no, because then you immediately fall into the inevitable, we have big asset gathering, because that's how the economics, that's how that works. And I don't want that. I want the autonomy and the freedom. And so, yeah, I'm not trying to build up a legacy firm, but I guess trying to pass on to the kids a way of thinking. That's as good as I got. I have to check with Ian. I think he's on board with that.
Hi, thank you so much for sharing your journey and Blue Heaven's journey. Really fascinating stuff. I'm just curious to know a bit more about the incredible work you're doing with TrimTab Impact. If you could explain, if you could talk about it a bit.
Sure.
What's the journey so far, and what should we look forward to seeing?
Okay.
Thanks.
Oh, great. Okay. So TrimTab is, we talked about earlier, which is a group of family offices that are focused on impact investing. One of the things that has come to light is a number of these families want to do more catalytic capital. So basically, right, we've got philanthropy over here where we've got market rate impact investing over here where we do like what we do at Blue Haven and try and find risk-adjusted returns, but within the impact space. But then there are things that are high impact, but not risk-adjusted returns. So either the time horizon's too long, the risk is too high, or they are in some way concessionary in nature. And so this space is trying to be defined as catalytic capital, right? The stuff in between pure philanthropy and market rate impact investing. And so that there's a number of investors that are saying, actually, I don't want to do like what you guys do at Blue Haven, where you have a market rate impact investing portfolio and then you give money away. We don't want that. We actually don't, we just want return of principal over like a 20-year time horizon. 12% and then give money away. Over 20 years, can you tell me that we'll just return the principal? And what is the absolute highest and best use of those dollars given those parameters? And I don't have liquidity needs. I don't need cash flow. I just want highest impact for that money, but I want the capital to recycle. And currently, if you were to say, okay, so build me a portfolio of that, there's nobody that can do that. There's nobody that can find a portfolio. There's people can say, oh, have you talked to 1 Acre Fund? Have you talked to, like, the opportunities? But what TrimTab is trying to do is to say, okay, how do we organize? How would you actually build a portfolio, a fund of funds of catalytic investments? And how do we categorize them? And how do we think about risk? Because a 1 Acre Fund risk profile, then say warehousing a deal for a new fund manager. But I think they're both catalytic. But so what TrimTab is basically a firm that is creating a catalytic capital fund of funds and trying to kind of sort through that market so outside capital can invest in it. And we are helping to launch that with Blue Haven. That's actually one of the fund managers we're warehousing deals for. To start kind of getting going. But I think that's really exciting because that type of rare. I mean, are you kidding? Someone saying, oh, I just need my money back after 20 years. Like, what? And so that investment committee is like super fun. And so that's what TrimTab is. And yeah, starting to build that up. That's not like officially launched
Stay tuned,
yet.
everyone.
Yes.
I think we could probably keep going, but thank you all for your questions. Thank you for those watching online. Thank you, Ian, for looking after the kids. And thank you, Liesel, for spending the night with us.
Thank you.
Thank you.
This is great.